You know me as Mr. Wonderful from Shark Tank. And today, I'm going to give you a warning that could protect your retirement savings in 2026. Listen to me very carefully. Right now, millions of retirees are making a dangerous financial mistake. They're chasing risky investments, betting on hype stocks, speculating on crypto, and hoping the market keeps going up forever. I've been investing for over 30 years. I've built companies, I've sold businesses for billions of dollars, and I've watched entire fortunes disappear because people ignored one simple rule. When you're retired, protecting your capital matters more than chasing returns. And here's the reality most financial advisors won't tell you. In retirement, a single bad investment decision can wipe out 10 or even 20 years of savings. You don't have decades to recover from mistakes anymore. That's why today I'm going to break down the three safest investments retirees should be focusing on in 2026. Investments designed to generate income, preserve your wealth, and protect you from market chaos. These are the same principles I use when I evaluate investments for stability and income. So pay attention because what I'm about to share could make the difference between a me secure retirement and running out of money. Now, before I show you the safest investments for retirees in 2026, I want you to understand why this conversation is so important right now. I've been investing for over 3 decades. I've built companies from scratch. I've negotiated deals with some of the toughest investors in the world, and I've managed portfolios worth hundreds of millions of dollars. When I sold my company, SoftKey, for $4.2 billion, I learned something that most investors don't fully appreciate. Making money is one challenge. Protecting it is an entirely different skill. And when you're retired, protection becomes the priority. Right now, the financial environment is changing rapidly. Interest rates have moved dramatically compared to the near zero era we saw for more than a decade. Inflation has proven far more persistent than most economists predicted. And market volatility, the kind that can wipe out portfolios, is becoming more common. Let me put this into perspective. Many retirees today are living 25 to 30 years after they stop working. That means your retirement savings must last longer than ever before. But at the same time, the traditional strategies retirees relied on in the past are being challenged. If inflation averages even 3% to 4% per year, the purchasing power of your money can be cut almost in half over 2 decades. That means the $1 million retirement portfolio you think is secure today could feel like $500,000 later in life. That's why I tell retirees something very simple. Your investments must do three things at the same time. First, they must generate reliable income. Second, they must protect your capital from major losses. And third, they must keep pace with inflation. When I analyze investments through that lens, the list becomes much shorter. In fact, in 2026, there are three categories of investments that stand out as the safest options for retirees. And I'm going to walk you through each one, starting with the first asset class that has been quietly creating wealth for disciplined investors for decades. Let's begin with something I personally love: high quality dividend stocks. Let me start with the first investment I want retirees to pay attention to in 2026: high quality dividend paying stocks. Now, listen carefully because many people misunderstand what I'm talking about here. I'm not talking about speculative growth stocks. I'm not talking about trendy tech companies that promise profit someday. And I'm certainly not talking about companies that burn cash year after year. I'm talking about established, profitable businesses that generate massive cash flow and return part of that cash to shareholders every single quarter. Why does that matter? Because when you're retired, income is everything. You need investments that pay you consistently without forcing you to sell your assets during a market downturn. Let me give you a simple example. Imagine you own shares in a company that pays a 4% dividend yield. If you have a $500,000 investment in that company, you're generating $20,000 a year in income, regardless of what the stock market does in the short term. That's powerful. And the best dividend companies don't just pay income, they increase it over time. Some companies have raised their dividends for 25, 30, even 40 consecutive years. That means your income grows even while you're retired. Now, when I evaluate dividend stocks, I follow very strict rules. First, the company must have strong free cash flow. If a business isn't generating real profits, the dividend isn't sustainable. Second, I want to see low debt levels. Too much debt destroys companies when interest rates rise. Third, I want a long history of dividend payments. Companies like large consumer brands, major healthcare firms, and stable energy producers often fall into this category. These are businesses people rely on regardless of economic conditions. And here's the key point most investors overlook. Dividend stocks reduce something called sequence of returns risk. That's a fancy term, but the concept is simple. If you're forced to sell stocks during a market crash to fund your retirement expenses, you permanently damage your portfolio. But if your investments generate steady dividend income, you can continue receiving cash without selling your shares. That's exactly why so many sophisticated investors build retirement portfolios around dividend income. Now, does that mean dividend stocks are risk free? Of course not. Nothing in investing is completely risk free, but in my experience, and I've seen thousands of portfolios over the years, high quality dividend stocks provide one of the most reliable income streams retirees can own. But here's what concerns me even more. Even though dividend stocks provide income, they still fluctuate with the stock market. Which brings me to the second safest investment retirees should be looking at in 2026, an asset class that is suddenly attractive again after more than a decade. And that investment is government bonds and treasury income. Now, listen carefully because the second safest investment for retirees in 2026 is something that many investors ignored for years. Government bonds, particularly U.S. Treasury securities. For more than a decade after the financial crisis, interest rates were extremely low. Bonds were yielding almost nothing. In fact, many investors abandoned bonds completely because the income simply wasn't worth it. But the environment has changed. When I look at the numbers today, I see something very interesting happening. Government bond yields are now significantly higher than they were during the 20102 SOAS for 20 period. That means retirees can once again generate stable, predictable income without exposing themselves to massive market risk. Let me explain why this matters. When you buy a government bond, you're essentially lending money to the government in exchange for regular interest payments. And when we're talking about treasury bonds, we're dealing with one of the most reliable borrowers in the world. That reliability is extremely valuable for retirees. If you buy a treasury bond yielding 4% or 5%, you know exactly how much income you'll receive every year. There's no guessing. There's no speculation. The payment schedule is fixed, and when you're retired, predict to be. Lighty becomes incredibly important. Now, here's a strategy I like to discuss with income-focused investors. Bond lading. It's simple but powerful. Instead of putting all your money into a single bond that matures at one point in time, you spread your investment across bonds that mature at different intervals. For example, 1 year, 3 years, 5 years, and 10 years. This approach does two important things. First, it creates consistent income streams as bonds mature and pay interest. Second, it protects you from interest rate changes. As older bonds mature, you can reinvest that money into newer bonds that may offer higher yields. In other words, you're constantly adapting to the market without taking unnecessary risks. But there's another reason bonds are valuable in a retirement portfolio. They provide stability when stocks become volatile. Over the years, I've seen investors panic during market downturns because their entire portfolio was tied to stocks. When the market drops 20% or 30%, they feel trapped. But when part of your portfolio is allocated to bonds, you have a cushion. That stability gives you flexibility and peace of mind. Now, let me be clear about something. I'm not suggesting retirees should put all their money into bonds. That would ignore inflation risk. And over time, inflation can quietly erode purchasing power. But as part of a balanced strategy, bonds provide something every retiree needs: consistent income and capital preservation. However, there's another asset class I believe belongs in a retirement portfolio, one that combines income potential with inflation protection. And that's where the third safest investment for retirees in 2026 comes in. Cash flow real estate investors. Now, let me tell you about the third investment I consider one of the safest for retirees in 2026. Cash flow real estate or real estate investment trusts, also known as REI, ATS. I've always believed in assets that generate real income, and real estate is one of the oldest wealth building tools in the world. Why? Because real estate does something very powerful. It produces cash flow while also protecting against inflation. Think about it. When inflation rises, the cost of living goes up, food costs more, energy costs more, and guess what else tends to increase? Rent. That means well managed real estate assets often see their income grow during inflationary periods. Now, not every retiree wants to deal with owning physical property. Managing tenants, repairs, and maintenance can become a full time job, and that's not what most people want during retirement. That's where REITs come in. A REIT is a company that owns and manages income producing real estate, things like apartment buildings, warehouses, data centers, hospitals, and commercial properties. And here's the interesting part: by law, REITs must distribute at least 90% of their taxable income to shareholders in the form of dividends. What does that mean for you? It means REITs are designed to produce steady income streams. Many high quality REITs offer dividend yields between 4% and 7%, sometimes even higher, depending on the sector. And because those properties generate rent, the income tends to be relatively stable. But let me explain something very important. Not all real estate investments are created equal. I've seen investors lose fortunes buying speculative properties with the hope that prices will rise. They borrow too much money, they underestimate costs, and when the market turns, the entire investment collapses. That's not what I'm talking about. When I look at real estate for income, I focus on assets that generate reliable cash flow today, not promises of appreciation tomorrow. For example, logistics warehouses supporting e commerce, medical facilities, and high quality residential properties have shown consistent demand for years. And when these assets are managed by strong companies with disciplined balance sheets, they can produce income that lasts decades. But here's another reason I like real estate exposure in retirement portfolios. Diversification: stocks, bonds, and real estate don't always move in the same direction at the same time. By holding multiple income producing asset classes, you reduce the risk that one market downturn will damage your entire retirement plan. That's something every retiree should care about because the goal isn't just to grow wealth anymore. The goal is to protect it while generating income you can live on. Now, we've covered the three safest investment categories I believe retirees should consider in 2026. But before you run off and restructure your portfolio, I need to warn you about something because I've seen retirees make the same devastating mistakes over and over again, mistakes that destroy retirement savings far faster than people expect. So, in the next section, I'm going to walk you through the biggest retirement investing mistakes you absolutely must avoid. And trust me, ignoring these could cost you hundreds of thousands of dollars. Now, listen to me very carefully. Over the years, I've reviewed thousands of portfolios. I've spoken with investors across every income level, from small retail investors to people managing tens of millions of dollars. And I can tell you something with absolute certainty. Most retirement portfolios are not destroyed by bad markets. They're destroyed by bad decisions. Let me walk you through the biggest mistakes I see retirees making over and over again. Mistake number one: chasing hype investments. This is the most common one. Someone hears about a hot investment on television, social media, or from a friend who claims they've doubled their money. Suddenly, retirees start pouring money into something they barely understand. I've seen it with speculative tech stocks. I've seen it with meme stocks. And yes, I've definitely seen it with cryptocurrency. Now, don't misunderstand me. I'm not saying innovation is bad. Technology changes the world, but speculation is not the same thing as investing. When you're retired, your job is not to gamble. Your job is to protect your capital and generate income. If an investment depends entirely on someone else paying a higher price tomorrow, that's speculation. And speculation can destroy retirement savings very quickly. Mistake number two: overexposure to the stock market. Another mistake I see constantly is retirees keeping 80% or even 90% of their portfolio in stocks. That might work when you're 30 years old and have decades to recover from market crashes. But when you're retired, a major market downturn can be devastating. Imagine retiring with a $1 million portfolio and seeing the market drop 30% during your first year of retirement. Suddenly, you're down to $700,000 and you're still withdrawing money to pay living expenses. That combination is incredibly dangerous. I always remind retirees that diversification isn't optional, it's essential. Mistake number three: ignoring income. This one surprises me the most. Many investors focus entirely on portfolio growth. They buy stocks hoping prices will rise, but they ignore whether those investments generate actual income. When markets decline, those investors are forced to sell assets to cover their expenses. That's exactly the scenario you want to avoid. Income from dividends, bonds, or real estate allows you to fund your lifestyle without selling investments during downturns. Mistake number four: trying to time the market. I've watched professional fund managers fail at this for decades, yet somehow individual investors still believe they can perfectly predict when markets will rise or fall. Let me tell you something bluntly. Market timing rarely works. What does work is building a portfolio designed to survive different market environments. That's why I focus on income producing assets and diversification rather than predictions. Here's the bottom line. Retirement investing is not about hitting home runs. It's about building a portfolio that can deliver steady income and survive market volatility. And that brings me to something many viewers always ask me. Kevin, that's great advice, but what are you actually doing with your own money? Fair question. So in the next section, I'm going to walk you through how I personally think about building a stable, income-focused portfolio, the kind of strategy designed to protect wealth over the long term. Now, I get asked this question all the time, Kevin. If these are the safest investments for retirees, how do you actually structure a portfolio around them? Let me explain how I think about it. First, I always start with a very simple principle. Every asset in my portfolio must have a purpose. Some assets generate income, some provide stability, some provide long-term growth, but none of them are there by accident. When I'm designing a portfolio for stability and income, especially for someone approaching retirement, I focus heavily on three pillars: Same three we discussed today: dividend paying equities, high quality bonds, and income producing real estate. Now, I'm not going to give you an exact percentage allocation because every investor is different. Age, risk tolerance, and income needs all matter. But conceptually, here's how I think about it. First, I want a core allocation to dividend paying companies with strong balance sheets and consistent cash flow. These businesses generate quarterly income and often increase those dividends over time. T gives the portfolio a growing income stream. Second, I add government bonds and fixed income assets to provide stability and predictable returns. These investments reduce volatility and provide reliable interest payments. Think of bonds as the shock absorbers in a portfolio. They won't always produce the highest returns, but they help protect the portfolio during turbulent markets. Third, I like having exposure to real estate income, often through well managed RTS. These assets provide another layer of diversification and income. And because rents tend to rise with inflation, real estate can help preserve purchasing power over long periods. Now, here's something I emphasize constantly: I never rely on just one source of income. That's a mistake. Well, your retirement income comes from multiple sources: dividends, interest payments, and real estate income. Your financial life becomes far more stable. If one sector slows down, the others can continue producing income. And that diversification creates resilience because the goal of retirement investing is not excitement. The goal is predictability, stability, and peace of mind. Which brings us to the final point I want to leave you with today. Because if you remember nothing else from this conversation, I want you to remember this simple rule about protecting your retirement wealth. Let me leave you with one final thought. After more than 3 decades in business and investing, I've learned something that every retiree needs to understand. Wealth isn't built by avoiding all risk. It's destroyed by taking the wrong risks. And when you're retired, you simply don't have the luxury of recovering from major financial mistakes. That's why the strategy we talked about today is so important. I want you to remember the 3 safest investment pillars for retirees in 2026. First, high quality dividend stocks, companies that generate 8 real cash flow and pay you consistent income. Second, government bonds and treasury income, predictable interest payments that provide stability when markets become volatile. And third, cash flow real estate or REITs, assets that produce income and help protect your purchasing power from inflation. When you combine those 3 pillars, you create something incredibly powerful: a retirement portfolio built on income, stability, and diversification. Now, listen to me. Don't chase hype. Don't gamble on speculation, and don't let emotions drive your financial decisions. Smart investors focus on cash flow, discipline, and long-term thinking. If you build your retirement portfolio around those principles, you'll give yourself something far more valuable than just returns. You'll give yourself financial security and peace of mind. And trust me, in retirement, that's priceless.